Hello and welcome to Lab to Launch, the seminar series for researchers interested in pursuing entrepreneurship. I'm your host, Sarah Jane Murdoch, the Administrative Project Coordinator for the Institute for Innovation and Entrepreneurship at UT Dallas and the Operations Manager for the Venture Mentoring Service of North Texas. As we move through today's session, I invite you to post questions in the Q&A box for our guest speaker to answer. Our speaker for today's session is Bryan Chambers. Bryan is the VP of Capital Factories Accelerator and a general partner in the Capital Factories VC Fund, the most active VC fund in Texas. Prior to joining Capital Factory, Bryan helped to establish the Blackstone Launchpad and the UT Dallas Seed Fund at the University of Texas at Dallas, where he actively advises students, entrepreneurs, and early stage ventures and serves as a member of the entrepreneurship faculty. And now here is Bryan Chambers.
Thank you, SJ. It's great to be back. I always love being here, and I really enjoy talking about fundraising and early stage deal structures. It is one of my favorite topics to discuss with anybody. So I really appreciate you all having me. And with that being said, that's what we're going to cover today. We're going to talk about raising capital for your startups. This is going to be fast and furious. I do suspect it is tough to consume and digest all the information that I'm going to share with you. So please, as SJ mentioned, please ask questions if there's something that you'd like to go a little bit deeper on. And I suspect we'll also go over some Q&A at the end as well. So what I'd really like to start and make sure that everybody is keenly aware of is that there's primarily three different types of investors to raise money from. What this presentation covers today is also the most conventional and the most common forms of fundraising and raising equity. It does not get into some of the newer or more modern forms of raising capital, which are still less prevalent today, crowdfunding websites, what have you. This is the conventional raising money from private investors. With that being said, there are really three types of investors to raise money from. The people that you always start with, investors or people that you know because you have an extensive relationship with them or hopefully and maybe even past success together. Raising money from this particular audience takes the least amount of time and is definitely the easiest process. So if you happen to have these successes or successful working relationships with others in the past that will continue to back you or support you, this is exactly the best place to start. This process by itself, even when these are warm relationships and trusted relationships that maybe you've had for a decade or more, it still takes many months to do this correctly. The next place to begin identifying investors is by getting warm and highly curated introductions from other qualified investors or entrepreneurs. So using that particular network that might be very close to you to begin to meet more investors and get introduced to more networks. And that always really speeds the process up. The way that the private investment and early stage investment sector works is investors and VC funds, angels will much more likely be willing to take a meeting with somebody if it comes as an introduction from a qualified representative from that person's network. So with this being said, a process that already takes a couple of months is now going to take about 3 extra months to let those new types of investors build trusted relationships with a new founder at a venture. And then lastly, cold outreach. You still have to do it. This is still part of the process because very few people are fortunate enough to have large curated networks of all the resources that they need. So even cold outreach is still a very important part of this process, and it will take even an additional 3 months to work and to manage the pipeline of cold to warm to investment. So cold outreach, opposed to asking people for investment, is really more of an interest campaign. It's not an investment campaign. And that interest campaign is curating people to invite them to follow the business, follow the traction, with the intent that you may soon be talking to them about a fundraise. All right, to successfully fundraise, you'll really need to know how to do a couple of different things. Leverage your network to get meetings, be familiar with investor etiquette and best practices, value your business competitively, and determine the right investment structure. Number 3 and number 4 are what we're going to spend time talking about today, and these things are very connected. Valuing your business and determining the right investment structure are oftentimes can be part of the same process. And then lastly, managing a fully diluted cap table, an ownership table. A cap table is simply the story of a business from an ownership standpoint and capitalization, how people come on and how people come off of a schedule of ownership over time. So that becomes very important when you invite people to participate in your business and owning and knowing what a cap table looks like at any point in time. So getting into valuing your business competitively, how much is your business worth? Another way to ask this question is, what's your pre-money valuation, or what's your valuation cap? This is another way to simply say, how much is your business worth? And then frequently, it's also understood to be, or what's your post-money valuation cap? These are all the same way to answer the same question. What's your business worth? How are you going to value it for an investor? What's your pre-money valuation? What's your valuation cap? What's your post-money valuation? Generally, all the same question provides the same information, but you arrive at those numbers for slightly different reasons and slightly different methodologies. At the end of the day, your business is really worth what somebody is willing to pay for it, to acquire it, to invest in it. And valuation fundamentally is as simple as that. The goal is not to begin with the highest valuation. This frequently is one of the biggest problems in early stage in venture that I see. The goal is really to end with the high valuation. It's not to charge your earliest and most risky investors who are there to support you, is not to penalize them by charging a really high valuation. It's really to get them the best, invite them to participate in the success of the business. And when businesses are a little bit more established, there's a couple of different revenue valuation methodologies that begin to tie into investment structures. What's the asset value of a business? This is plant, property, equipment, intellectual property, any related inventory. So what are the assets worth? And perhaps if the business is not successful and somebody goes in and acquires it, it's going to be worth its asset value. A multiple on EBITDA. This is mostly a function of how services businesses get valued. So like an accounting firm or a law firm, perhaps even a doctor's office or a doctor's practice, is going to be how much money do they make at the end of the day. And then let's create a multiple on the multiple of 8 or a multiple of 10 on earnings. So think about it like profits. And then if there's X profit left over, there's going to be a multiple of those profits. Multiple on trailing 12-month revenue, that's what TTM stands for, trailing 12-month, is going to be an even bigger number. You're not necessarily taking the profits, but rather all of the revenue. This is really what happens when scalable tech companies begin to be valued. Because they're inherently more scalable than services businesses, they will use a different figure, oftentimes trailing 12-month revenue. And that's particularly true for something that we might call tech-enabled. It really has a heavy services component, but a very unique method to scale those services via technology. Monthly reoccurring revenue or annual reoccurring revenue is the gold standard for venture capital, and which also frequently means angel money, which comes before venture capital. So getting your customers to buy an annual license or pay a monthly reoccurring fee for a particular service, and then frequently an annual run rate or annual recurring revenue is a snapshot at any moment in time for the future for the next 12 months. And then taking a multiple on that is really customary valuation methodology for emerging technology companies. And then a multiple of future revenue is when companies have very promising potential and very meaningful upside. This tends to happen in two different scenarios. One, for companies that don't yet have any revenue, but have very exciting potential. And then secondly, companies that have a track record of growth. So if a company's annual run rate revenue or annual recurring revenue is $100,000, but it's consistently growing, then investors will pay a premium because of a demonstrated track record of future growth. And so they'll bump multiples even higher. So today, and I think what's most applicable to the audience that's participating today is really going to be something that's pre-revenue, but really has that the potential to monetize in its earliest forms. And so that's what I think that's what will be the most applicable strategy. So how do we value our company if there's no revenue yet? Well, it's probably something to the tune of $500,000 to $5 million. There's lots of variables to factor in there, but do a lot of research, and yes, ask an expert, ask a lawyer. Lawyers close a lot of deals, and they'll have often what we call in the investment sector peer comparables to draw down examples from. I happen to know if Mike Marcantonio from Live Oak did a particular deal and what they paid for that from a valuation methodology or valuation multiple. And when I look at a similar company, I'll use that as a measuring stick to say, am I paying more or less or about the same as what other investors are paying for a like-kind investment? And so that's called a peer comparable. And but at the end of the day, the most important thing that you can do, and I think this is relevant for all very early stage companies, is to choose an investment structure that is flexible, so that, because you will get that number wrong, and almost all people do when it comes to deciding on the right number to value your business. If it's something that's tricky or confusing, or you think professionals are not weighing in on the process to get it to an exact science, then choose a structure that will allow you to keep it flexible and will not penalize you when you get it wrong. The two most common ways, and let me take a stop for a second. SJ, do we have any questions at the moment, or would you like me to keep going?
We just have one question. When and how do you start trying to build a medical advisory board? How do you recruit and convince these people?
Yeah, early. The earlier, the better. I can tell you, I think of advisors and mentors very different. Mentors are people in your network that will want to help, and they will do that out of the kindness of their heart. They usually don't do that like a full-time job, but they will do that out of the kindness of their heart because they want to see you succeed. They really enjoy giving back. And to me, advisors are compensated. And I think that typically tends to be somewhat true, where advisors are highly strategic and uniquely involved in your business, almost always because they're compensated with some sort of advisory engagement or ownership or earning into shares or the upside of your company relative for their engagement. So to me, I think it's very important to build a network of mentors exclusive to supporting your business, and then select from that mentor network advisors that will be excellent to supporting you. And you ask those advisors to really help deliver a very specific set of outcomes that you're working on. I think you can't do this early enough in the process, and the reality is at every different stage in your business, your mentor networks and your advisors will always be shifting and always be changing to some extent. So I would tend to err on the side of do this frequently and do this as early as possible, because you will need that. You will need their support. So the two most common ways to raise money by selling equity, you can break them down into two different concepts, two different methods. A priced round, or AKA what you will frequently hear as a Series seed or a Series A raise. This is selling equity in exchange for cash. What I'm going to raise $1 million in exchange for 10% of the company. By the way, just so everybody is aware, that would mean that my pre-money valuation is $9 million. You're investing $1 million in exchange for a post-money valuation of $10 million. 9 million plus your 1 million equals the new value of the company to anybody after that investment is it's valued at $10 million. 9 plus 1 million that just came in, we're valued at $10 million. And the 9 million pre-money valuation affords the investor or gets the investor 10 million or 10% of the company. The second way to do this is, and in a priced round, you really need to nail the very exact valuation, what somebody is willing to pay for it. When you don't know that number, or lots of people will disagree or are unable to arrive at consensus, you'll raise in what's called a convertible security. There are two types of convertible securities: convertible debt and something that's referred to as a SAFE, a simple agreement for future equity. And these are very, very similar instruments, and both almost always include a valuation cap, a discount, and what we frequently refer to as a most favored nations clause. And we're going to talk about these specific terms in just a second. SJ, do we have any other questions?
A couple of questions. They're still sort of life science focused. One is specifically in the life sciences. We've seen insane valuations in the past couple of years, given the RNPV DCF analysis done for biotech. How are folks arriving at these valuations, and what do the valuations look like in the incubation VC pre-IPO stage?
It's a great question. I think DCF is really a methodology used for more mature companies or companies that have pretty clear, very obvious business models. And DCFs are not used when business models are still largely unknown, being investigated. And so I think there's two very, very different methodologies. Or perhaps when a company that goes through lots of FDA levels of kind of FDA compliance and phases of FDA certifications, every time a company passes a huge new regulatory hurdle or is approved, there's a lot of value in that time and that complexity. So that's, to me, I don't think DCFs are used much in venture. In the last 220 investments that I've been a part of making, we've never used a DCF. It's never actually factored into an investment decision. DCFs tend to be used a little bit farther along in companies when investment banks frequently get involved. Larger dollars end up being raised as a means to really understand what the future revenue is going to be because of almost data science, financial science, if you will.
And just a quick follow-up to that, how can younger founders get started in life sciences, putting together an experienced team and finding technologies?
Network. You got to network. You got to get out of the building. You've got to go to all the events that are being put on by the Office of Research, by the Institute for Innovation and Entrepreneurship, by Capital Factory. Dallas Startup Week is going on. But most importantly, you've got to potentially get very outside of your comfort zone. Get out of the lab, get out of the classroom, get out of your house, and you must go build relationships, because they will not be coming to you. You must go to them. So I'll leave it at that. You must be very intentional about networking and asking for introductions and asking for help, asking for introductions to those mentors and to those advisors. So just be very intentional and be very loud about it, and that tends to, attract people your way. With a Series seed equity raise or a Series A raise, it costs a lot of money. This is, again, this is again where you get your exact valuation formula to a science, and there's a bunch of people willing to participate in it. It costs always, I mean, $25,000 or more in legal fees, but more frequently, sometimes as much as $100,000 to do this correctly, to paper the company, paper the investments, and complete the legal due diligence when it comes to a priced round. That's a lot of money. It's also customary in equity raises for the startup to pay for the investor legal fees. So if it costs the startup $25,000 and it costs the investors $25,000 also, you, for the sake of conflicts of interest, really need two different attorneys doing the deal. Then the startup is really going to pay $50,000 to close that deal. And from the new funding that will come in from the investors, 25 will go right back out of it to pay their attorney. And so it's very customary that that's the case. We don't like that as startups, and we don't like the high legal costs, especially for something that might be really hard to nail. Series seed and equity raises, Series A raises, are very lengthy and complex. They usually, usually almost always require detailed terms, complex changes to operating documents, bylaws, conversions from LLCs to C Corps, etc. If these things aren't occurring, you're probably doing it wrong, and you're probably going to pay the price for it later. So always recommend doing these with venture attorneys who really know how to navigate and build the foundations for companies to go on and raise the next equity round and the next equity round and the following equity round after that. Going back and cleaning things up, the later stage you get becomes extremely expensive. There's a couple of terms and a couple of facets of equity raise that are pretty particular, that are almost always included in an equity raise. One of those is a priced valuation. Got to get it, again, exactly correct. What is the exact cost of a unit or a share? And then board seats and voting control on important matters. If you're not ready to decide on all these items, then don't do an equity raise, because it's really important that that all of this gets figured out. Understanding what the right liquidation preferences are to use, redemption rights, and understanding how and when investors are going to get their money back. At least thinking about it. Founder vesting. Investors aren't excited to invest into a startup or a new venture if that founder is not fully committed. They're going to make you earn. You might own 60% of your business as a result of raising some money, but investors want to ensure, professional investors, that you're going to stick around and you're actually going to earn that 60% of the business over 4 years. Just because you started the company doesn't mean you own it outright. And if you leave after 1 year, then you're leaving, walking away from it. And it's a mechanism. Everybody's aligned. Things like co-sale rights and tag-along rights and drag-along rights are all pretty complex terms that really need to be understood and thought about very clearly. I'm going to show you a couple of examples of those, but before I do it, SJ, are there any additional questions?
Not right now.
All right. Well, then let's fly through. Let's look at an example that I extracted from a term sheet. This is a Series Seed preferred equity. The investor intends on investing a minimum of the lead investor, $1.5 million, but allowing an extra $500,000 to come on top of that. That extra $500,000 will be what's called from a follow-on investor. So the lead putting up 1.5, with the company being allowed to raise up to $2 million in aggregate. So something else you might notice right below here, and these aggregate commitments, these milestones are tranched, 2/3, 1/3. So the investors are saying that we want to put this up and we want to do it in a way that will give you $1 million of that 1.5 today. And then when you hit certain milestones, we're going to go ahead and release the extra $500,000. And so that is a very unique component. You can do very unique things like this in priced equity. And you can see here towards the bottom, $12.27.5 is the exact price relative to the pre-money valuation that these investors are going to buy units or buy shares at. Dividends occur just like an interest rate, but because it's not debt, interest rate is a function of debt and dividends are a function of equity, but it functions very similar to what you would think an interest rate would look like. Dividends accrue, and it's a bare minimum acceptable return that an investor will want to compound on their $1 million investment. So after year one, it's $1,050,000. After year two, it's 1.1 million. So they're gaining, their equity is appreciating at a minimum of 5%. And then a liquidation preference is a very important concept to understand. And you can see here, it says 1 times the original purchase price. Well, in the example that we used, we'll continue. I raised $1 million on a 9 million pre, sold 10% of my business for a 10 million post. And let's say along the way, year three comes along and I haven't needed to raise any extra money. We're trying to, but we're not finding traction. And I'm getting pretty tired as an entrepreneur, and somebody swoops in and says, I'll buy your business for $7 million right now. And since I happen to own the overwhelming majority percent of it, 90% of the business, that sounds really attractive to me. I'm tired, so I'm going to agree to sell the business. Well, meanwhile, the investor only owns 10%, so they get $700,000 back. That is absolutely not fair, because we used their $1 million to go create the value, create sales, file intellectual property, make progress, and recruit and find a buyer, all things that allowed us to find a buyer for $7 million. So it doesn't make a whole lot of sense for a founder to take 6.3 million of that and then deliver 70% of the value of that investment back to the investor when we used it to create all the value. So a liquidation preference is the right for the investor to say, I want 1 times my money back, or I want the greater of 1 times my money back, or the value of the fair market value of my price per share. So at that $7 million, the investor would say, after 3 years, I want 1 times my investment back plus any accrued and unpaid dividends. If it's 3 years, it's going to be $1.15 million that the investor is going to get back. So they'll have a little bit of a return. Frequently, we see liquidation preferences sometimes be 2 times or 3 times the original purchase price of an investor, and it guarantees them a return before the founder can take a return and monetize the sale of their business. Voting rights, you can see there's lots of different complex matters. All of these things have to get carefully thought about. What happens under change of control, and who can take out debt, and who can change salaries of the executives, and how much they get paid. All of these things have to get discussed and decided on, and they become governing rights. So I'm going to go ahead and talk very quickly about why you shouldn't do these in the earliest stages of your business. And we're going to go ahead and show you very quickly. Convertible debt, it's a debt instrument that assumes a near-term financing event or a buyout. It automatically converts into equity in the future based on time or a key event, a financing event. It only focuses on a handful of the most important terms, and it defers all those things like board seats and voting matters and redemption rights, and it defers all those complex matters to a later time, because somebody else is going to come in later with more money and define those things. It's much cheaper to raise money via convertible debt. It's senior to what we call senior to equity before conversion, and investors find comfort knowing that in an interim period, they actually hold debt, not equity. And in the event that things go really, really bad, that debt holders always get paid back before equity holders. And so here are the key terms that always go into a convertible note. Everything is mentioned right here. The term, how long is it going to be debt before it converts? What's the interest rate on that debt going to be? What's the valuation cap? And the valuation cap is a ceiling. It's not a guaranteed number. So we think $5 million is a fair number, but in the event that somebody 1 year later comes in and puts in $1 million at a $4 million pre-money valuation or a post-money valuation, doesn't really matter, we're going to get a discount to them because we were in the deal earlier. And so we're going to get a deal that was at least 20% better than they got at a later time. So our price gets retroactively dropped relative to what happens later to ensure that it's fair and equitable for all parties. Conversion occurs by really one of two things: a maturity date or a qualified financing event that happens when somebody puts in more money in the future. And then another famous clause that's in almost all convertible debt and safe agreements is something that's called a most favored nations clause. And this basically says, in the event that you at a later time go back and give better terms to somebody than what you gave to me as an investor, that you retroactively adjust my terms so that it's equal to the person at a later time. So it ensures, also ensures favorable terms and conditions. So early stage investors don't accidentally or unintentionally get screwed when they do a deal. So lastly, is a safe is very similar to a convertible note or convertible debt, but it is not debt. It is a contractual obligation. It's a very creative type of convertible security that's a contractual obligation to issue equity or return capital. It also assumes a very near-term financing event from a VC. So the key difference is it's not debt, therefore there is no interest rate and there's no maturity date. It costs less than $5,000 to do these. You can download all the agreements. It's a template, and it's very well received from early stage investors. So not much has to be changed. It's kind of an industry agreed upon standardized form to raise money. And so, but always recommend having an attorney bless it, and that will cost a little bit of money. And there's three real key terms that occur in a safe, and that's the valuation cap, the discount, and again, the same economic terms or a most favored nations clause. And again, the valuation example real quick is if we take a B2B software as a service company who sells to enterprise companies, so enterprise AI software, those businesses sell at about a 6x to 12x revenue multiple, so on annual recurring revenue. So if we use the average, we'll think of it like 8x. So if the current ARR, annual recurring revenue, is $600,000, the business at any point in time is going to forecast it's going to make $600,000 if it doesn't add any additional revenue or any additional contracts. Then $600,000 multiplied by the revenue multiple equals a 4.8 pre-money valuation. And that's how somebody can arrive at a basic pre-money valuation. So how much do the investors get? Well, again, if they invested $1 million at a $4.8 million pre-money valuation, then the formula is simple. It's right here. It's 4.8 million plus the investors $1 million equals a post-money valuation of $5.8 million. And this formula is very simple, but it's very important to understand. The investment amount, that 1 million, divided by the post-money valuation means the investors that the company has sold or will be selling 17.24% equity to investors. I'm going to go ahead and stop there. I think we're right at a little over the half hour. And let me go ahead and take any questions.
Yeah, there's a question about bylaws. How important are founding bylaws to later capital raises, especially if those bylaws can be redone?
They're not, but they're not important if you're using standard bylaws. We don't look at any of them, and we don't read them. They're very important. That's not to take into consideration how valuable and critically important they are, to build the foundation of a company. But every time somebody prices around, bylaws and a company operating agreement gets entirely redone. So you only really want to do it one time, and you want to do it early, and then you want to make minor changes to it along the way. So when you're not raising very much money, perhaps sub $1 million or sometimes even sub $5 million, depending on what sector and what the company vision is, you don't really need them on the front end. You need to have an attitude and approach that the second somebody comes in and purchases equity in the company and does a qualified, professionally led round, they're going to tell you what the bylaws are going to need to be, and you're going to agree with them or not. So professional investors are very particular about what needs to be in company bylaws and operating agreement. And those discussions, I tend to encourage people to punt on that until a professional investor gets involved who can very successfully help you navigate what they should and shouldn't be. If you try to do it out of the gate, you'll get it very wrong, and you'll spend a lot of time and money and resources on it. So defer it. When you form your company, your attorney should be able to say, hey, these are the norms, these are the standards, this is what we suggest you start with, and it will get changed when professional investors get involved. But when angel money is being raised via a SAFE or via a convertible note, you don't have to change any of the bylaws or the operating agreement.
Our next question is about negotiating. Where can we get practice negotiating?
It's a great question. I would really recommend a couple of books, to 3 in particular, which at the UT Dallas Seed Fund, we all recommended all the students to get a crash course in VC and how this process works. But negotiation is really a function of education. You can't negotiate if you're not educated and how to navigate a venture deal. So 3 books. Probably the most important that I'd recommend would be a book that was authored by one of the most active VCs, a partner of mine. I love this book so much. It's called Startup Success by Gordon Doherty, and it's speaking through to a founder who's building a venture, an early stage venture, with anticipation to fundraise. The second book I'd recommend is a book. It's kind of the original book by a gentleman, Brad Feld, also a very active investor, called Venture Deals. But it's through the lens of a VC telling a founder how to go negotiate with a VC and all the things that are important to a VC and why deals get done that way. The book is a little bit antiquated. It's a little old. It's pre the movement of convertible notes and safes. However, it's still very insightful to understanding what is going through the mind of a VC and how they work, so you can get in position to negotiate with them. And then lastly, a new book came out, and I think it's a little bit like Venture Deals. It's kind of the modern version of Venture Deals, but it's really all about the Silicon Valley culture, and it's called Secrets of Sand Hill Road. And this was written by Scott Kupar, the general partner of Andreessen Horowitz, questionably one of the best VC in the world ever. And they wrote the book to kind of give a modern day version of how fundraising has occurred and occurs today in Silicon Valley. So I would start by getting educated, and I would immediately read Startup Success.
Yeah, those are great recommendations. Thank you for that. Our next question talks about, in light of the pandemic situation, they're asking if there's any impact on venture investments.
Great question. The answer is yes and no, and let me explain. What I really mean when I say that is there are trends that changed, and these impact, but from economics and the amount of money flowing, not much has actually changed. What we think about things at Capital Factory, we created what we called a COVID impact score. And this was 0 to 5, with 3 being in the middle, totally business as usual, unaffected. Business, so the COVID impact score is 3. That means that company actually saw benefits as a result of COVID and was able to capitalize on changes or opportunities that led to more revenue, more customers as a result of that. That might look like a education technology company, by way of example, or and a 5 might be a company that's totally surging. Oh my gosh, we're achieving results in that we thought we would have achieved in 2 years from now, but we're getting them now because it was so freakishly timed. And that might look like a company that builds a virtual meeting solution or an online collaboration tool that now everybody is forced to use. So really accelerated growth. That's going to be an example of a 5. So the inverse is exactly, it's just a mirror replica. A 2 COVID impact score is we're probably not going to die, but we're going to have to recast our projections. We're probably going to have to lay off or furlough some people. We're negatively impacted, and we're not going to achieve the growth of the projections that we set out to before COVID. And 1 really is totally screwed, probably going to die. As a result, we'll die faster and accelerated death as a startup. And so we think about things under a COVID impact score. Now, separately, what happened, the National Venture Capital Association pushed out a report at the end of Q2, and it showed that despite all the confusion and the chaos because of COVID, national venture capital only dropped 6%. And when I first read that and learned that, I was really impressed. I thought it would be way more, 25% that it had dropped, if not maybe 30%. To really learn that venture capital only dropped by 6% was astonishing. So the same pace of deals is really is occurring, and in some areas, in some sectors like Boston, it's as high as it's ever been in the history of venture capital. So because Boston is a very med tech, pharma oriented city, a healthcare innovation city, and so money and innovation money flocked to Boston in this particular time. So Boston was surging as a geography and is doing better than ever. The rest of the nation not doing very poorly. There's no real very, very minor changes. The changes come in if you had a business that was really doomed or destined for failure because you weren't building a post-COVID business, that in a modern business post-COVID, then people are probably not as interested in looking at you as an investment opportunity anymore. So the trends are really changing, and it accelerated trends. But investments are happening. Investors are investing more money now than almost ever before. And I'm reminded in 2018 and even in 2019, more VC funds raised more money than in a long time. And as a result, VCs are sitting on cash. That money has to go to work. If it sits there and it doesn't go to work, then VCs get penalized from that on the ultimate calculation that VCs measure as a fund and fund per investor performance, which is called internal rate of return. The faster they deploy that money, the more rewarded they can be for getting it to work, and the higher IRRs naturally. They'll suppress IRRs by sitting on money and not allowing it to get put to work. So VCs raised more money, are sitting on more cash, and really need to go get it to work. And we're now starting and seeing investment activity pick up like COVID never really occurred. For a minute, there was a healthy 30 to 60, maybe even a 90-day pause. But generally, we're seeing great investment activity, and we should continue to see great investment activity, but perhaps just to new areas that didn't always get that attention.
So unfortunately, we only have time for one more question, but I do want to remind the audience, I did put a link in the chat for our booster session, so you are welcome to join us there. And if I didn't get to your question, you can ask it over there. So the last question I'll add is, much of your seminar is fascinating and full of information. I don't have a background in business, and I need resources to utilize to understand the important business and legal jargon. What would you recommend I utilize to gain a better understanding of entrepreneurship?
I'd recommend reading Startup Success. I think it is a very, very modern book that just came out, and I think it's really designed and written for the first-time founder who is not an expert on the jargon, on the strategies, with a background and track record of building a business, and help startups navigate that entire process. It's an excellent book. It is simple, but it is profound at the same time. Gordon Doherty is truly one of the best investors, one of the best entrepreneurs I've ever had the opportunity to work with. And so I would say start there. You're going to have to invest into the process. So building, reading and getting educated, and then intentionally building networks of mentors that can help you in these areas. VCs and investors actually like founders that are technical in nature and aren't just business. The more insights or deep domain expertise that a founder can bring to the table is very, very valued by investors. But those founders are going to have to learn the business side of it, or they're going to have to surround themselves with people that are going to participate and help make and support those business decisions.
Well, awesome. Thank you so much, Bryan. We really appreciate it.
Of course, always. I always enjoy being here and looking forward to connecting with some of the audience and helping how I can.
Great. So our next Lab to Launch session, it's going to take place on September 14th at noon. We'll have Dr. Walter Voigt as our guest, and Bryan has graciously volunteered to do some fireside chats with some guests that we have. So thank you again for doing that. And I just wanted to remind everyone, we actually have our big idea competition coming up in the fall. Our research commercialization track applications are currently open until September 20th. And lastly, again, if you'd like to continue our discussion, please join us at the link posted in the chat. Thank you, everybody.